Hey everybody, are you paying too much to trade options? Well, if you're not on public.com, the answer is yes. Public is the only platform where you earn a rebate on every option contract traded, and that's in addition to no commissions or per contract fees. There's no one else out there paying trading rebates, so you won't find a better deal. Bottom line is, if you're paying more than $0 to place an options trade, then you're paying too much. Switch to public and start getting rebates on every single contract traded, only at public.com. Paid for by Public Investing. Options not suitable for all investors and carry significant risk. Full disclosures in podcast description.
Hey, everybody. Welcome back to Investing Unscripted, where we ask and answer the hard questions about investing. That guy over there, that's the voice of the people. His name's Jeff Santoro. He's my good friend. I'm Jason Hall. You know that, Jeff.
I do know that. After 2 years of doing this with you, I know your name. Yes.
Yes. Now, my question is, do you know how I'm doing?
I know that you're doing fantastically well.
It's true. It's true. Jeff, you're a little more of a closed book than I am. How are you doing?
I'd prefer not to say.
That's okay. That's fine. How about if we do a podcast instead? What do you say?
Sounds good.
Awesome. Okay. This week's episode is going to be called Building a Crash Resistant Portfolio. So a little thing happened. I'm thinking about getting t-shirts printed up that said, I survived the carry trade crash of 2024.
All 2 days of it?
Yeah, all 2 days of it.
I like that we rushed for our schedules to put out a rough cut about the market falling, and then it went live the morning that the market rallied and came back, and we are recording this after the market close on the 7th, and it is another good day in the market.
Yeah.
So
it is another good day on the market. So, but the point is, this is a timeless topic. And even though the markets have kind of started to recover, they haven't fully recovered, but they've started to recover. This is definitely a topic I think that should be compelling for a lot of people, because my guess is not our listeners. We have the best, smartest investor listeners in podcastdom, but there are definitely a lot of people that panicked and did some panic selling, maybe some panic buying that looks smart right now, but definitely a lot of panic selling happened late last week and definitely on Monday. So part of what we're going to talk about is not just like the portfolio construction itself, but constructing your frameworks and having a process that helps you to also be crash resistant.
yeah, and we got this idea actually from a listener named John who sent us an email last month, I think, and just had an idea for a show, something he was curious about. So that's where we got the idea, which reminds me to remind everyone listening, we always ask you guys to send us questions for our mailbags every month. But if you have show ideas, that's another thing you can send our way. We're always open to building episodes around what the listeners are interested in. So, Jason, let me read John's short email to us, and that can start us into the conversation here. So John wrote, I know you covered some of this in the beginning, but a pod on portfolio construction and position sizing would be helpful. This is an important aspect to me that seems to be overlooked. It is a great way to manage risk, something I learned the hard way early on. So that was the genesis of this episode. So I think a place to start, Jason, is to let's talk about some definitions, at least the ones we're going to use as we talk through this, because I was recently talking to a bunch of investors, and there were some things that I thought were just easily understood that confused some people. So I figure we should probably get some groundwork definitions under our belts here. So when you and I are talking about our portfolio, when we use that phrase, let's tell everyone exactly what we're referring to. So when you are saying your portfolio, is that everything? Is that just your stocks? How does that work for you?
So, I mean, different people might think about this differently, but I think the best way to think about it is all of your investable assets, things that you own specifically for investing purposes. So for some people, you might factor in, maybe you own some rental properties, things like that might fall into this category for some people. Not always, but that might make sense. In my case, when I'm talking about this, what I'm talking about generally are long-term investments that can be quickly and easily liquidated. I have a couple of private investments in startups that are sizable, but they're not so substantial that it would really alter the numbers that I talk about. And I think to keep it relevant for most of our listeners, generally when I'm talking about my portfolio, I'm talking about stocks, bonds or bond funds. I have a very small exposure to bonds now that's going to grow over time, but stocks and bonds funds, and also cash that is inside investing accounts for investing purposes. So my money in the family's short-term savings for emergency funds, and also for like saving for vacations and all that kind of stuff, that's not included in this. So it's investable assets that basically live inside my brokerage accounts, retirement accounts, rollover retirement, taxable brokerages. It excludes my kids' college savings and a small UTMA that we have. So this is just the bucket of money for me and my wife for our long-term financial gains that we have invested. How do
Yeah.
you think about it?
Mine's pretty much the same. When I say my portfolio, it's pretty much all of my invested wealth. So it's my and my wife's retirement accounts, it's brokerage accounts, it's the little bit of cash that I have dedicated to investing, like you said. And for me, it's never a lot of cash. I stay pretty fully invested, and I know you like to have cash on the side. I also exclude my kids' 529 accounts. I exclude the UTMA brokerage accounts I have for them as well. And yeah, and I don't count like my house, for example. Like I don't
Yeah.
consider that as, when I calculate my net worth, I can include my house, but I don't
I'm
use
glad
it.
you used those 2 words, net worth, because that's a different thing
Right.
than thinking about just the portfolio. Now, I think
Yeah.
it's important that you consider your net worth and your portfolio, separately and together, right? When you're thinking about your total accumulated wealth and long-term goals, but definitely differentiating the two is important.
Yeah. No, I agree. Historically speaking, and in most cases, your house can be there is an asset because most housing most of the time goes up in value over time. And I know that's not all the time. So that's why I do think I agree with you. It's good to know your total net worth, including your house.
Mhm.
But I think for this purpose, for us talking about our portfolios, we're not including that. Now, I don't know that the way we define it is necessarily the correct way. I know other people who define their portfolio when they talk about position sizing and allocating and things like that differently. And I think so everyone has to kind of make that decision. Like I could imagine a scenario where if you owned one or more rental properties, for example, you might consider them to be part of your portfolio, but not necessarily your primary residence, right? So neither of us own
Right,
rental
exactly.
properties, so that's not uh,
Yeah.
a thing that we have to worry about. But anyway, so when we talk about it, those are the definitions that we're using and referring to. So here's another thing we're going to probably say a lot that we should clear up, which is when we say cost basis versus like the value of our portfolio. So the cost basis is simply the amount you contributed to said account, and the market value is what it's worth right now. So for example, if I bought $100 worth of Verizon stock, just to pick a random stock I don't own,
Why would you buy $100 worth of Verizon
I
stock?
wouldn't. I don't know. I
Why
wanted
would you
something
use
that
it as an example? That's just a bad example.
your face is a bad example. I just wanted to pick a
Okay.
random stock I don't own, so I picked Verizon. But I'm sure someone listening owns Verizon and likes it, so let's not denigrate it too much,
I'm
Jason.
I'm sorry, listener. I'm
All right,
very sorry
so
for your thoughts and
let's say
prayers.
I bought $100 worth of Verizon stock. My cost basis is $100. Let's say it is now worth $120. The value of that stock is $120. So I think you and I are both on the same page, Jason. We think of percentages in our portfolio as it pertains to position sizing by the percentage of the total cost basis. At least that's how I talk about it. I think you do the same thing, correct?
I think about it in both ways, and I'm gonna give a much, much better example. Yes. So I'm gonna use Mercado Libre,
Never
because
heard of it.
it's yeah, yeah, yeah. The reason I wanna use it is because it's really easy for me I'm looking at my portfolio right now, and I can give the real world numbers of how it stands in my portfolio. It is right now, it is 6.25% of my portfolio. That's based on the market value of all of my Mercado Libre stock as a percentage of the market value of all of my portfolio including the cash that I own, the stocks and the cash, the bond ETF that I have a little
Your
bit.
portfolio as we defined it a few minutes ago.
Right, right. The market value of it today. Now, it's 3.55% of my cost basis. What that means is that it's 3.55% of all of the dollars that I have invested in all of the stocks that I currently own. Make sense?
Mhm.
So I'm going to make up some numbers. So let's say the portfolio is worth $1 million. So that means I have $62,000 worth of Mercado Libre stock if it's $1 million portfolio. But I've only invested $500,000 of actual money, right?
Right.
And it's gained in value to get to that million. So I'm not going to try and do the math on that 500,000, but 3.55% of that is what I've actually bought. So that's what I think about cost basis. And I think it's important to think about both of those things, because it helps you from over extending into stocks in how much cash you want to allocate into them. But also it's really, really useful. Like KNSL Capital is almost 4% of my portfolio. I've only invested 1.2% of my cash into it. Right. So it helps me think about maybe that's one that, given the right valuation and the right opportunity to buy, I kind of benchmark. It's like 2 to 3% typically is about as much cash as I want to invest of my cost basis that I want to invest in most of my stocks. So that's one way that I think about it is, on the high end, you think about, kind of capping risk with percentage of your total portfolio and then extending it from there to percentage of your net worth. So for example, somebody that 50% of their portfolio was Mercado Libre, that sounds like a massive, scary number, but maybe they're 35 and they've been investing for 7 years, right?
Yeah.
That's a different story. And maybe it's somebody that's 50% of their stock portfolio, but you know, their stock portfolio is 25% of their net worth because they own a small business and they also own some rental property, right? So that's where you have to think about these things broadly across these different ways.
Hey, everybody, we'll be right back, but first, a word from our sponsors.
FinChat.io is the complete stock research platform for fundamental investors. They have all the standard financial data on more than 100,000 stocks globally. But beyond that, they have company-specific segment and KPI data on around 1,800 stocks. So for example, do you want to see NVIDIA's data center revenue growth? They've got it. Do you like to track Apple's iPhone sales? They've got that too. Or how about nights and experiences booked for Airbnb? You guessed it, they've got it. And they just added around 8,000 ETFs and mutual funds to the platform. The breadth of FinChat's data is truly one of a kind. I use FinChat every single day as I'm researching the stocks in my portfolio, specifically when I want to see how they're doing on KPIs that FinChat is famous for. So to get 15% off any paid plan, go to finchat.io/unscripted. That's finchat.io/unscripted to get 15% off any paid plan today. The link will be in the show notes. Hey, Investing Unscripted listeners, this episode is brought to you by our friends at Yellow Brick Investing. Yellow Brick is an aggregator of the best stock pitches across the internet. By tracking thousands of blogs, newsletters, fund letters, podcasts, and more, they're able to collect and summarize the best stock pitches from all over and bring them to you in one single place. Think of it like a modern value investors club. I have to say, this is pretty cool. I can just type in the company I'm interested in and get a bunch of different stock pitches from across the internet. It helps me think through new ideas and find opposing points of view on the stocks I'm interested in. And the best part is, access to Yellowbrick is completely free. Try it for yourself. Simply go to joinyellowbrick.com and search a company or ticker you're interested in. You're bound to find a great report on just about any company. That's joinyellowbrick.com. Yeah, and I know some other people who, when they speak about position sizing, they use the market value of their portfolio as the benchmark rather than cost basis. And I don't think, again, that there's a right or wrong way. It
Yeah.
depends how you want to think about it.
Both are
How,
useful, I think, is the
yeah.
key. Yeah.
No, I know. I agree. But
Yeah.
what I'm saying is, like, if you and I, like you just said, you have not a rule, but like you typically put 2 to 3% cost basis into a position and then kind of let the market do the rest.
Right.
I know other people who might have the same guideline, but they use the value of the portfolio as what to base that 2 or 3% on. So
Right.
I think it just
But
matters how you want to think about it.
I want to say one more thing about it that I think is the most important thing, thinking about frameworks and the why behind all of these different ways to think about it. The fact that they exist doesn't matter. It's why it's important to use it. And the idea is thinking about diversifying your portfolio, reducing downside risk of too much exposure to individual companies or risk factors that multiple companies may share is probably the biggest thing. Is when again the whole idea of this of building the crash proof portfolio is giving you different ways to think about your exposure to the different companies that you might own.
Yeah, no, that makes sense. So I was going to go in a different direction, but you just said something that I think is worth diving into right now. So we've established some of the language we're going to use and what it means for us. But since you started talking about that benchmark or that guideline of 2 or 3% of your portfolio cost basis being as much as you're going to allocate to any one stock or any one position in your portfolio, generally,
Hmm.
let's talk about let's talk about diversification within the portfolio itself. And I think there's two ways to think of this. There's the way to think of this as you're brand new and you're just starting out. Maybe you're 22, you just got out of college and you're really beginning your investing journey, or maybe you've come to this later in life, or maybe you're like me and you've had decades of index fund investing under your belt, but now you want to get into individual stocks. How do you think for most people, I know you're a little bit a special case because you're entirely in stocks, or at least mostly.
Yeah.
How do you think most people should think about what they have in their portfolio, but both in terms of like stocks versus other asset classes, and then also in terms of like how many of each of those things to own, or what percentage of each of those things to own? Any like broad kind of guidelines you think are smart for people to consider?
Yeah, it boils down to largely when your financial goals are going to occur, and then a little bit thinking about managing your own risk tolerance. So, one of the most common questions that financial advisors ask people is, they give you like the multiple choice questionnaire, and one of them is, would you like a portfolio that could generate 25% of returns, but here's the percentage of loss versus the percentage of gain? Give you like those different options to choose from. They're trying to figure out how much volatility would upset you. Like how much would it impact you and therefore impact their ability to manage you as a client. And that's really about managing volatility because the financial services industry broadly considers volatility and risk kind of to be the same thing.
But we think of it differently, right? The
Well,
difference between
yes and no.
volatility and
So our
risk.
brain thinks of it as risk, right? Because you look at your portfolio on a day that it's red, like this past Monday, and I mean, it's like somebody punching you in the stomach. Like your brain sends like those same signals that when your pain receptors fire, right? It actually physically hurts you, and that hurt is worse than the pleasure your brain gives you when your stocks go up, right? You can have a stock go up 50%, and it feels good. You can have that same stock go down 20%, and it feels worse than the good feelings from the stock that going up even more, right? So, like intellectually, yes, we definitely view it differently. But here's the caveat. It gets back to what I was talking about is when your financial goals are. Because
Mhm.
if you're somebody that's in your early 20s up through, I mean, even into your 50s and maybe early 60s, where you're a net contributor of new money, downturns are opportunity. Volatility is an opportunity, right? Because it gives you an opportunity to pay a better price, a lower price, and potentially gain additional returns when the market, reverts than you would have gotten otherwise. Now, that volatility is a negative when you have too much exposure to volatile assets that you're going to need to turn into money in the short term, right?
Right. It's like the younger you are, the more volatility is opportunity, and the older you are, the more volatility is risk.
100%. No, that's
Yeah.
exactly right. That's the key. So to me, diversification across asset classes largely. So again, thinking about cash as right now we're kind of in this lucky environment where we're getting pretty good yield on cash, particularly considering that inflation's coming down. So now like the real return that we're getting, the after inflation effect on the spending power of the power of that cash is actually pretty good. It's even better in a lot of cases than we're seeing in bonds. Now, bonds typically, historically, I mean, if you're thinking about like treasuries, like super safe bonds, you can get better yield in corporate debt, lower credit rating stuff that maybe is less than investment grades. You're starting to get into like some of the junk stuff. You can get much better yield in some pretty safe debt. So again, the idea there is you can get even better returns, but still lower risk than stocks, because the difference between a bond and a stock is stocks trade in real time all the time, and everybody's just kind of making an educated guess what they think the business is worth. With bonds, you basically know what it's worth. The variable is what are the interest rates going to be in the future, and that affects the value of the bond in real time. As interest rates go up, the yield on the bond becomes less valuable, so it drives the value of the bond down. When yields fall, the interest rates fall, the yield on that bond is more valuable. So you could actually sell the bond at a higher than par price. Par is the face value of the bond. But if you own bonds, when the bonds mature, you get all the money back anyway. So you can disregard the volatility, right? So it's a way to not have to worry about the volatility and get better yield for kind of shorter term periods, like, 3-year, 5-year sort of periods. That's where bonds, I think, for most investors can come in handy. And then stocks, 5+ years, where again, the volatility is typically opportunity more than risk, with the caveat that we haven't seen it in the past decade, but you go back most downturns historically, the round trip from the prior high to a new high can be 3-5 years sometimes. So
So
that's the risk.
I'm glad you mentioned bonds because I think it would be helpful. I want to think about building a portfolio from two perspectives.
Yep.
Perspective one is you want to have different types of assets in a portfolio. And then I
Mhm.
think the other way to think about it is you want to be all in stocks. And I think the reason I want to bucket it that way is because that's sort of where you and I are in terms of how we have our portfolios constructed.
Yeah.
You're almost, you mentioned you have some private investments, but beyond that, you're mostly in stocks, a little bit of bonds and a little bit of cash. And I'm mostly in index funds and very little stocks. So I want to talk about how I think about diversification for my portfolio,
Mhm.
and then you can maybe talk about how you think about it in yours. So for me, a lot of my diversification is because I'm in index funds and ETFs. And so with each of those individual index funds or each of those individual ETFs, within each of those is a bunch of different stocks or bonds or whatever it happens to be. So I'm diversified even within the diversified things I have in my portfolio. And that's 85 to 89, 88% of my invested wealth is that.
Yeah.
So that's sort of like automatic diversification for me, at least how I look at it. Now, if I look at what I actually own in those index funds and ETFs, it does skew largely towards stocks. So it's something that as I get closer to retirement, as me and my wife both get closer to retirement, I might think about what types of index funds and ETFs my money's going into, because I might find that as I approach retirement, I'm a little bit too exposed to stocks because,
Yeah.
as I said earlier, the older you are, the volatility can equal risk.
Well, that's the
Um,
thing, right? Because those index funds are a great way to achieve diversification and reduced single company risk and
right.
single, sector risk and that sort of thing. But you're still 100% exposed to the risk, the volatility aspect of risk of
Yeah.
stocks.
I mean, we're decently diversified. I mean, the biggest chunk of money is my wife's 401k, which is mostly in a target date fund. It's not
Which
entirely
will automatically reset and increase
right.
your exposure to bonds and cash over time.
Right. Like, so the largest pot of money is in a target date fund.
Mhm.
So that big chunk will be automatically diversified, probably in a little bit more of a conservative manner than I would like. But that's
I'll say too, I wanna give the financial services industry a little bit of credit, because when target date funds came out, there was a lot of crap baked into them where you were basically paying like a substantially higher fee to a fund manager to manage your investment into funds that they were also managing, that they were getting asset management fees on top of. So big double dipping was going on. And it's gotten a lot better where there's still a small premium you pay, which you should, because they're going to manage it and they're going to make changes over time on your behalf. But they're great. I really think broadly they're great.
Yeah. So I I want to just pause on index target date funds for a split second here, because I think for most people who really don't understand or want to understand all of the stuff we're talking about, they can be they can be the perfect vehicle because they're set it and forget it. They automatically get more conservative as you get closer to your retirement age. The one piece of advice I've heard from multiple people is to maybe pick one that's a little bit beyond your retirement age. So if you can retire in 2050, pick the 2055 or the 2060 one, just so it's a little bit more stock heavy for longer. But even if you don't do that, there are worse things you can do than just pick the target date fund that coincides with when you want to retire and just put money into it for your whole career and never think twice about it.
Yeah.
And that's the reason that such a large portion of my wife's 401k is in that, because that's exactly the amount of effort she wants to give to all of this.
Yep.
So, and I think that's probably how most people are. And in fact, I had some of my retirement accounts are also in the same thing, because before I learned more about all this, I had the same mindset as well. Set it and forget it, not worry about it. So anyway, most of my money is in those index funds and ETFs. So that gives me, I think, as much diversification as I need right now. And then, like I said, 10 to 12% of our portfolio is in individual stocks. And that's what I like to think about and talk about and spend time playing with.
Well, and it gives you an opportunity to really kind of concentrate on your best ideas.
Mhm.
Because even if your best idea goes wrong, it's not going to undermine your retirement or other financial goals.
Well, that's why, I've said it a bunch of times, but I'll say it again. I probably am too diversified in my stock portfolio if I think about it in as a part of my whole portfolio.
Yeah.
Right? Like I spend a lot of time thinking about 10% of my portfolio, and I spend no time thinking about 90% of it.
Yeah.
So, I think I'm leaning towards over time whittling it down to less stocks, because I can be a little bit, going back to the risk conversation, I can afford to be a little bit riskier in that 10%, maybe take some bigger swings, maybe pick some companies that I really like that are not sure bets to do well over time, right? Be a little bit more risk on in that sense, because like you said, I mean, the entire stock portfolio could go to zero and it would suck. No one wants to lose 10% of their wealth, but it's not 80% of my wealth, right? So,
Right.
Right. And again, this is where my being risk averse comes into play, because I can't quite bring myself to be that risk on in that little part of my portfolio. So, all right. Anyway, that's how I think about it. And I think I don't want to give advice to anyone, but I think for people starting out, I like the idea of only getting into stocks after you have a little bit of a base of index funds to sort of serve as like the foundation for your portfolio.
Mhm.
But that's just my personal thing. Like I think if I were starting over right now, that's probably how I would think about it. All right. Now you are mostly almost entirely
Yeah.
in stocks. So how do you make sure that you are diversified enough? And then how do you think it might change as you get older?
Before I answer that, I want to push back just a little bit. This isn't really, it's not really a pushback, but with the target date funds, one of the things you mentioned is that some of the kind of the prevailing advice that's been given to a lot of people over the past 5-10 years is maybe go into a fund that's a little further out than you when you're actually going to retire, so you can increase your exposure to stocks and reduce how quickly you get exposed to bonds. A lot of that advice was given when yields were exceptionally low, exceptionally low. I think that prevailing wisdom is starting to change because the yields have gotten better. And I think for your average person out there, going with a fund that's actually close to the date you're going to retire probably still does make more sense now than extending it longer did before we've seen rates kind of return to more historical levels.
Yeah, no, that's perfectly reasonable. I think an easy thing to do is look up one and like look up the 2024, like look up the one or this year, and just
Yeah.
see what's the percentage of stocks versus bonds, and then look up the one that's 10 years from now, 15 years from now, 20, and just kind of see how it
Right.
changes. Because you might say to yourself, oh, I don't want to be 60, I don't want to be 40, 60 bond stocks even in retirement. That might be too, that's everyone's personal preference. But you can go see what they are now and kind of get a sense of where it'll be when you're whatever age, 45,
Yeah.
55, 65.
Exactly. Exactly. We say set and forget it, but I think it's still, every year when you do your family financial review, review that every year, revisit that every year. I think is healthy. So, okay. So back to thinking about stocks and what diversification means for me. Historically, again, you meet with an advisor, they're going to talk about sector exposure and trying to minimize downside risk with too much exposure to one sector. And, I think a lot of that is true, because it's just like any type of over concentration or exposure, can come with substantial risks. For example, like, two examples. One is the energy industry. If you had have bought a lot of energy stocks, and the energy industry actually doesn't include renewables. The energy industry is oil and gas. Most of the stuff that's in renewables, the companies that operate all the equipment, like the Brookfield Renewables, et cetera, those are utilities. They're not energy companies. The companies that like the solar panel makers and all that stuff, they're semiconductor companies. They're tech industry companies. So if you buy just the sector ETF, that's the energy company, it's oil and gas. But point is, if you had have gone heavy into energy in 2014, when oil prices were still over $100 a barrel and had been for, like 2.5 years before that, you would have lost your shirt over the next decade. Well, really 7 or 8 years. It was a brutal, brutal period of returns for energy stocks. At the same time, if you had have bought the QQQ, which is the NASDAQ 100, which is almost all tech and telecom, you would have gotten like 16 or 17% returns a year, right? Massive, massive upside. So, but again, those are just kind of sector things. The way I invest, because I kind of go everywhere, is I try to think about when I invest in companies and I start to have a lot of exposure in companies that might look different. I try to think about how are they potentially exposed to some of the risk factors. I'm going to give two examples that I actually don't own either of. Ford and Lululemon, two very different businesses, both have massive exposure to discretionary consumer spending, right? And if the economy gets weak, they could both go through protracted periods where their results aren't great. And if you pay a high valuation, kind of on the front, maybe like late last year, you could really hurt if there's a protracted downturn. And you could look at like Lululemon and Hershey, and you might think maybe it's the same thing. They look like they have kind of the same consumer exposure. But then Hershey, which I actually do own a little bit of, is one of those companies that kind of benefits from like the lipstick factor, lipstick rule. I can't think of what exactly they call it, but basically it's one of those things that when the economy's weak, people will spend a little bit of money on something that's a pleasure or kind of a treat, like chocolate or a new color lipstick, when they're not going to buy a new pair of Lulus or buy a new car. So thinking about risk factor similarities to me is more important necessarily than thinking about sector exposure.
Yeah, I want to pause on the sector exposure thing for a little bit, because I know there's some people out there who feel like I have to have a little bit of every sector. I have to have something in energies, I have to have something in financials, and I have to have
Yeah.
something in whatever, consumer discretionary. And just because that's the way they think of diversification, I don't think you and I think that that's necessarily the way you have to go. But if you did want to, it's perfectly reasonable to supplement your portfolio with ETFs that give you exposure to those sectors that, for whatever reason, you might want exposure to, but you don't want to be necessarily have to decide like what's the winning stock. Like for example, you and I both own individual cybersecurity companies, but I know some investors I really respect who are individual stock pickers, but who just say to themselves, I know cybersecurity is important and it's going to be here forever and it's a secular tailwind industry, but I can't even begin to start picking the winner. So I'm just going to buy a cybersecurity ETF and call it a day.
Mm-hmm.
So I just wanted to interject that in your little explanation here, because I think that's a way to go if that's what you desire.
Yeah, I agree. We like to talk about our wins and things that we've done well, but I think mistakes and lessons. We try to learn from ourselves, but I think sharing those mistakes and lessons with other people can be really useful as well. But thinking about exposure and different factors, risk factors, admittedly, one thing that I didn't do very well was as I started building out kind of a high yield dividend growth portfolio back in 2020, 2021. This portfolio is going to generate better yield and dividend growth than I'm paying on my mortgage. So like the mortgage payoff portfolio, I didn't really think about when I started initially building that portfolio about interest rate risk and how it can affect dividend stocks, especially stocks where dividend and pay a higher yield is a bigger part of the thesis for investing. And so I built a very diversified portfolio of companies with different opportunities and risk factors like that were directly tied to the business. But I never really considered what happens if interest rates really go up a lot and how it's going to affect how the market values those stocks based on either their cost of capital needs for taking on debt to fund their business or for bonds or even just cash to become more attractive for yield. And it certainly affected the returns versus my expectations.
Yeah, you just said something that made me think of another aspect I think is worth pointing out. I remember during 2022 when the market went into that prolonged downturn, my portfolio got crushed. And part of that's because I bought a lot of stuff in 2021 and 2020 that was overvalued. And part of it was because I had a pretty growth oriented portfolio, a lot of tech stocks, a lot of things that were high flyers that just did not hold up well when the market turned. And I know some other investors who did better in terms of maybe they even matched the market's downturn and didn't, lose to the market or maybe even beat the market in 2022 because they had, I guess, what you would call, more stalwart type stocks in their portfolio, things that are a little bit more stable. So I don't have a deep thought about this, but I think it's worth considering based on your own risk and tolerance for volatility to think about, like, do you want the kind of portfolio that has the potential to just completely outperform the market in really good times? Or do you want a portfolio that is going to be a little more durable in down times? Or do you want a combination of both?
Yeah. Yeah.
And, we had Jason Moser on a couple weeks ago. And one thing I've heard him say a bunch of times on podcasts, and I think he might have even said it to us, is for every high flying, more speculative stock he has in his portfolio, he tries to pair it with a more tried and true staid company, right? So like for every high flyer, he has a Home Depot or a Costco or something like that, something that's just going to be like there, not going to blow your socks off with growth, but also not going to drop 50% when the market plummets, right? So those are just two other things that popped into my head as I was hearing you talk that I think are worth considering.
And that's one of the reasons, I've talked about the barbell approach that I take.
Yeah, you've talked about it too, right?
That's certainly something that I do for that specific reason is more of my capital flows into the high flyers. I tend to take smaller bets in more businesses. And that part of my portfolio, like I fully expect. I mentioned it on the rough cut that we did that morning on Monday. My portfolio was down like 6 or 7%. Like it was down a ton. The market recovered some, but my portfolio was still down a lot more than the market was that day. But the corollary, or the inverse, I should say, also holds true that on good days, my portfolio is usually gooder on those good days. And because there are generally more good days than bad days,
Yeah.
it works. If you pick the right investments or enough of the investments are the good ones and the winners, it works out to your favor. But I do have that ballast of those dividend stocks, the stable, stalwart, like the Hershey's, for example, that tend to be a little less volatile than the market and maybe over the long term, and big bull runs are not going to necessarily do as well. But then you start factoring in the dividends and look at the total returns, and they can be surprising as well.
Yeah, and that's why I have to think carefully about what kind of stock portfolio I want. Because again, it's only 10 to 12% of my overall portfolio, but I do know that in 2022, I trailed the market pretty bigly. But in like November and December of last year, remember we had that
I'm really proud of us. We got Bigly and Gooder in the same part of the show here.
in November and December of last year when we had that crazy bull run heading into the end of the year, my
Mhm.
portfolio drastically outperformed the S&P 500, and it
Yeah.
almost it kind of made up for the whole year just in that little. So I don't know, I have to think about that. Like I like the fact that in a really good run, my portfolio tends to do better than the market, but it is tough when it is a bigger loser than the market during downturns.
Well, part
Oh,
of the portfolio that you build that's gonna be successful or not, and realistically, it's gonna be like there's a range of outcomes, right? It's not gonna be one or the other, is having a portfolio that helps you manage yourself or that's
mhm.
manageable based on your personality.
Hey, everybody, we'll be right back, but first, a word from our sponsors. Earlier in the show, you heard us talk about investing platform public.com. That's where you can trade options with no commissions or per contract fees. And you get a rebate of up to 18 cents per contract traded. NerdWallet recently gave Public 5 out of 5 stars for options trading. If you want to see why, go to public.com and start getting a rebate of up to 18 cents per contract traded. Paid for by Public Investing. Options not suitable for all investors and carry significant risk. Full disclosures and podcast description, U.S. members only.
Hey, Investing Unscripted listeners. My name is Brett, one of the hosts of the Chit Chat Stocks podcast. If you love Investing Unscripted, we think you will love listening to Chit Chat Stocks. On our show, we research individual stocks, interview investing experts, and, well, chit chat about investing every week. From hot stocks such as Nvidia and Celsius to hidden small cap gems, we have something for every type of investor. Follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts and level up your investing skills today.
Yeah, so much of this is just what's going to let you sleep at night and that kind of a thing. All right, I want to switch gears a little bit because part of John's question was about portfolio construction, but part of it was about position sizing.
Mhm.
And I think, I think a lot of people who listen to this podcast are stock investors. I know you're entirely in stocks. I think a lot about stocks, even though it's a smaller part of my overall portfolio. I don't, I, again, I've come at this from a bunch of different angles. I would love to be the kind of person who can buy in bigger chunks. Like I love the idea of buying in thirds. Like to use your example, if you decide 2% of your cost basis is as much as you want to put into a company, buying in thirds, I like that idea. Split that dollar amount up, buy it 3 times. I know people who that's the way they invest. If they decide tomorrow they're going to buy Hershey, just to use your most recent example, they're
Mhm.
going to buy a third of it today. They're going to buy a third of it in today plus X, right? Whatever they decide, a month, a quarter, 2 months, whatever. And then
Yeah.
they're going to buy the other third after that. No, no matter what happens. They just commit to it. They put it on their calendar. I'm buying today, I'm buying on this day, I'm buying on this day, done.
Hershey's actually a perfect example because that's actually what I did. I bought 1% with
Yeah.
the intent that my cost basis will probably be around 2% over the long term. Of course, that cost basis is gonna grow, right, as I invest in more new dollars all the time. But you might look at, I don't know, Upstart, for example, or a Lemonade when I made my first investment in that. It might have been a 0.5% or less, that starter position. But I think you have to approach different businesses different ways, Jeff. I think that's important too.
Yeah. No, I agree. I want to get to the starter position thing in a second,
Mhm.
but I think what I struggle with the idea of like buying in thirds is, and I'm going to say this carefully so it doesn't sound like I'm like trying to make it sound like I have this enormous portfolio because I don't. As you get older and your portfolio grows in size, buying a third of a position
It
could
just
end up
takes more
being
money.
it could be yeah, and it could be more money than you have going into that account every paycheck or whatever your cadence is.
Right.
And that's the position I'm in. And it's partially because I don't have this enormous portfolio, but I have one that I think is appropriately sized for someone my age who's been investing, right?
Right. Yeah.
Um,
Yeah.
and but the bigger piece is most of my investing dollars don't hit my brokerage or my IRA for me to buy stocks with.
Right.
Most of my investing dollars go to my retirement account. I never see those dollars. They
Through
just
your
go
employer. Right.
boom.
They go straight into index
Right.
funds.
So for me to wait to buy a third of a position with the money that comes into just the stock part of my portfolio, I would have to wait months. Okay. And that's not some sort of humble brag. It's literally just because that there's not a lot of money coming in for my stocks. And I just don't have that patience. I don't. So I end up dollar cost averaging. I just dollar cost average less regularly than I used to. I used to be like every Wednesday I would buy something. And now it's whenever the mood strikes me, I spend what's in my account. So sometimes it is a month because I've just been busy, and sometimes it's 2 weeks in a row. Sometimes I want to buy something and I don't have any money because it hasn't come yet because I haven't waited long enough for the automatic transfer to come over. All right. I want to circle back to what you said a minute ago about treating different companies differently,
Yeah.
because I know some people who take a starter position that's the same size no matter what it is, whether it's the most speculative bet they've ever made or whether it's a stock that they have
Mhm.
100% conviction in. But it sounds like you do something differently based on what you're buying. So why don't you talk a little bit about the way you think about an initial purchase of a new stock?
Yeah, so I think as a starting point, most of the people that listen to our show and most people out there are in the same exact boat you are, Jeff, where they're investing through an employee retirement accounts. That's where the majority of their investable income is going. And so any individual stock buying that they're doing, you're just not starting out with enough money to make that full position. So there's another term, a full position, meaning the total amount of money you want to invest in an individual company, right? That's your full position. It's your cost basis of dollars that you want to invest. It's the most you plan to buy. Most people just can't. I'm fortunate that because essentially all the work that I do is as a contractor, I'm self-employed. So I have a solo 401k. So I get all the benefits of a 401k without an employee match or an employer match. I mean, I can match my own funds. Um, I get the tax benefits of it, but it's not free money. But I just have more working capital, right, to invest in individual stocks at any given time. So with that said, I think if I were to use two words to kind of break down how I think about starting initial investment in a company, it's predictability and profitability. So we can stick with the Hershey example and we can bring in Confluent as kind of the startup-y, unproven, trying to be a disruptor example. So Hershey, I've been following Hershey for years, and it's only been in the past few months that it was really moving up to the top of my watch list as a stock to buy because of valuation concerns. If you look at the business, incredible returns, great margins, highly profitable business, exceptionally predictable business, but the stock was just very, very richly valued. So it just remained on my watch list. And then a number of things happened. There was I remember if it was the Bear Cave or somebody did a short report and shorted the stock. And part of their thesis was Feastables, Mr. Beast's chocolate brand, which sure, it's fine. And I'm sure it's going to be very successful, but it's not going to send Hershey to zero, right? So massive distribution, operating leverage, like all the things. Hershey has all the things. The stock just didn't make sense. So I had all the things that I wanted from the business, and I had to wait for the stock valuation to make sense. And when it did, boom, 1% investment, which is pretty large for me to make as a single investment in a company. But that tells you my conviction in the business, because if you look at their history and it's the kind of business too that you don't have to worry about management making missteps in the same way that you would a startup where, the level of expertise of the people running the business and their chops and understanding of the business itself and the industry is super duper important. Now, Confluent, on the other hand, upstart business and they kind of created the category with data streaming, wasn't profitable, wasn't cash generative. So I started like with 1/3%, and over a 3-year period have built it up to where my cost basis now is actually close to 2% because I have very high conviction. And even though the stock has come down a little bit, I continue to have a lot of conviction in the business. It's gotten to cash flow positive. So now there's some predictability. So that's kind of how I think about it, is kind of slow playing the smaller upstart businesses, and they have to earn more of their capital through their results, right? And through their taking market share. And I will invest more and more over time.
So it sounds like with a more speculative bet, you end up basically dollar cost averaging, just not in any sort of regular way.
It's not as mechanical, right?
Right.
That's exactly it.
Whereas if it's something like Hershey, you might just buy the full 1% right off the bat, and then maybe add a full 1% down the road, maybe, right? Like it's just,
that's exactly right. I
yeah,
mean, I could see, not adding another dollar to Hershey for years, or maybe I decide to buy more in a couple of months, right? Depending on how much capital I'm looking to deploy, because I want to be regular about my investing. I don't want to sit too long and build up cash and not be a regular buyer. But I may not see other opportunities and just come to the conclusion that Hershey makes sense because maybe the price stays where it is for 6 or 8 months, or we get some more volatility that sends the stock even lower, I would buy. But yeah, it's definitely still the idea of dollar cost averaging without it being automatic or just a mechanical process that happens on an ongoing basis. But it's definitely more making sure the businesses earn my money before I buy more of the business, and not focusing on the stock price. The stock price tells you something, but then you have to go, it's a flag, but it doesn't tell you what you need to know. Studying the business results is where you figure out whether the business is worth buying more or not. And my ideal, Jeff, is not that I'm buying Confluent shares cheaper, that I'm buying them at a higher price because the business is doing really well. The market recognizes that. The
right.
stock is going up because the business is delivering. And I'm happily paying more for the stock because the business is doing really, really well. Because generally, if the stock's down, beyond all the macro concerns that when a stock's down and every other stock in its category is down, if a stock's down, it's usually for a bad reason.
I want to hit on one thing before we move on we've been talking a lot about 1% and 2%, which sounds like small amounts. But I think it's important to remember that if a company that you put 1% in 5X's, right, does really well for you, all of a sudden it could be a big enough piece of your overall portfolio that it actually gets to the point where you might think, oh, this is starting to make me uncomfortable, depending on where your level of comfort is with one stock being that much of your portfolio. Does that make sense?
It does. So here's how I think about that. So let's use that 5X example. So you put 1% in your portfolio in this one stock, and your total portfolio doubles in value. But that one stock increases 6-fold in value. That stock is now worth well more than 10% of your total portfolio.
Yeah.
Right. So
I guess.
there you go.
I'm going to assume you did the math correctly, but
Yeah.
directionally,
it's
that's
much more. It's actually much more than that because I wasn't going to stop to do the actual math, but it's become an outsized portion of your net worth.
Right. So I just wanted to say that because I remember being a newer investor and thinking 1% seems like inconsequential. And, there's an expression that a longtime Motley Fool member said, and it's been repeated multiple times. Basically, if the stock's a winner, if the stock is a loser, you only want a little. And if it's a winner, you only need a little, right,
Yeah.
to do well. And I think that's something worth remembering.
It
All right,
it
so
is. Yeah. Well, and the other thing too, I think it's important to remember too, is again, when the numbers we're talking about, that's cost basis percentage that I'm talking about. How percentage of the dollars that I've invested that I want to invest in these companies. Again, that's going to change over time too, right? This
Right.
is
more
Hershey
money
is
you add to the
1% of
portfolio.
all of the
Yeah.
dollars that I've invested so far. That number is also going to grow over time too. So that's important to remember when you're thinking about this as well.
Yeah. All right. Last question as we wrap up here. We talked about how you think about a new position, a stock you don't already own. How do you think about stuff you do own, especially when big news happens? And we've talked about it a lot, but I think it's a informative example, just thinking about CrowdStrike. So
Okay. Yeah.
if, CrowdStrike had this big issue a couple weeks ago, it shut down half the world and the stock tanked. It's come back a little bit since then, but it dropped 20 something percent in a couple days. And we in the various times we've talked about it, we don't need to rehash the whole conversation. We've talked about the fact that if CrowdStrike is a tiny piece of your portfolio, you might think differently about how to react to that news than if it's already 8% of your invested wealth, right?
Right.
That might be the decision to buy, sell, or hold, right? So I wanted to see how you thought about that. Once it's in your portfolio, how does the size of the position within your overall portfolio impact how you handle news, whether it's very good news or very bad news?
So I think as a starting point, I've learned a lot to separate stock movement, stock price movement from the story, right? And really try to look at them as different stories. And we can use Upstart, Jeff, which reported today, and at some point during trading, the stock was up like 50%. And the results were not exactly up 50% good. They were fine.
Yeah, not 50% good though.
I
Yeah.
need to actually dig into them a little bit more, but they were fine, right? So that's really, really important. And then, of course, with the CrowdStrike news, the stock fell a little bit the day that the news broke about the outage. I mean, I think it was double digits. It was the end of the week. It was a Friday. And then the stock kept falling the following Monday. And that was the kind of thing where like the implications and the underlying story was actually really, really big and really potentially thesis altering for the business. And it's the kind of thing where I've learned that I have to think a lot more slowly about these things in general. But it's if there's one thing I've definitely learned, it's to slow down my process and to think more deeply and slowly about the business implications and not just reacting to the market's volatility. I will say I am more likely now when I start peeling back the layers of these stories and it just looks like the market is overreacted one way or the other to what seems like pretty mundane, a quarterly report or a story that's out there in news. I immediately go check the short percentage because there's a good chance that that's the story is shorts doing something, increasing shorts or trying to close and the stock's getting squeezed higher. So that's one thing I've tried to figure is like trying to get a little bit of an answer about what's going on with the stock, but really focusing on the business. And the business results look good, then I think about whether or not it's time to act on that.
All right. So we're near the end here. Any final thoughts that you have to wrap up the conversation about building a portfolio and position sizing?
Yeah, something we talked about a lot, Jeff, and that's building a crash-proof or volatility-proof portfolio. A lot of times is building a U-proof portfolio because this is so much about managing yourself and your own behavior. And we've talked about things that you can do to kind of inoculate yourself, like really starting with understanding what you own, why you own it, which makes it a lot easier to, or less, I should say, less difficult to get through these periods of volatility, which is the number one harm. My guess, and the data will probably back it up, Jeff, is that more investors are harmed by their actions during volatile periods than being too exposed or not exposed enough to certain sectors or being diversified enough. That's my guess. But building on that, it's the actions that you take to bolster yourself that I think are probably going to be more important than any level of nuance about diversification. Position sizing, I think, still matters. But again, that's going to come back around to you. So for example, some like me, like I do have some stocks. I think I've got 5 stocks that I have more than 3% of my cost basis in, but the vast majority are 1.5% or less. So somebody that has a portfolio of 20 stocks, if you want the same exposure, all of them, your cost basis is going to be 5%, right? For 20 stocks. If it's 25, it's going to be 4%. So you have to be mindful about things like that. But it really comes back around to managing yourself, I think, more than anything else.
Yeah, I agree with that. I think for me, it's about taking that step back and thinking about everything in terms of your overall goal and what you're trying to accomplish with all of your investments. Because again, thinking about 1% sounds like a little bit, but thinking about the dollar amount of 1%, if you have a portfolio because you've been doing this for a couple decades, can be a scary amount of money. So I do think it's, as you think about risk and as you think about volatility, I guess the summary comment for me is just to think about it in that big picture of your entire invested portfolio and also what you want to do with it and when you're going to need that money. Because the decisions you make when you're 22 are going to be different than the ones you make when you're 62.
Yeah, I think that about says it. Okay, friends, as always, let me close with these words of wisdom. We are not experts. Well, we're not both experts. So what does that mean? It doesn't matter that one of us is an expert and one is in education. What does matter is that these are our answers, friends, that we're giving. And it is up to you to find your own answers about diversification, position sizing, assets that you own, and how you build your own portfolio to create the wealth for you and your family and to avoid the risks that can undermine your financial success. You know what? You can do it. I continue to believe in you. All right, Jeff, we'll see you next time.
See you next time.